Hashing, you're muted.
Sorry. Hi, everyone. Welcome to our Phillip Securities Research Monday morning call. We have stock counter updates from JP Morgan, Wells Fargo, Bank of America, Netflix, and Keppel DC REIT. We'll also be having Phillip on the ground on Kin Global. So, for our technical analysis, we'll be looking at S&P 500 as well as our iShares Tech ETF. Last week, we conducted our US SSP, and we'll be providing a summary of that. And we'll end off with the Singapore Weekly. So this is just a disclaimer. The information provided is not financial advice. So with that, I'll pass on to the US team.
Thanks, Hashim. Yeah. So, as Hashim said, we did our US SSP presentation last Monday night. So we'll just do a very brief summary of what we went through. Yeah. Next slide, please. Yeah, we just go straight to the sector themes. So the first one that we'll be covering would be auto, more specifically EV and Tesla, as it's part of the Mac 7. Yeah, and we named it the Elon Musk ecosystem because, to be honest, Tesla is really just all about Elon Musk, and the stock. So the share price performance follows whatever he does, and anything that is concerning him. Next slide, please. Yeah, but back to the basics of Tesla. They did release their first quarter 2026 delivery numbers, and it's not a positive sign. It's not looking very good. If you look at the trend for quarter-on-quarter basis, you can see that it has been on this steady decline since the third quarter of 2025. Ever since the US, stopped or removed that $7,500 EV tax credit. We have seen deliveries in free fall. Yeah. And even in China as well, we're not seeing very good news. They are continuously losing market share to the Chinese competitors, particularly BYD and a lot of the up-and-coming competitors like Xiaomi as well. And so we believe that their growth engine has really stopped. Next slide. Yeah, so I'd like to touch on the SpaceX IPO. So that's one of the most important things that will be happening for Tesla in this year at least, right? And why we believe that this SpaceX IPO is actually Tesla's biggest competitor for Elon Musk's capital in terms of time, energy, money, and also effort. So the main question we'll be asking is like, why would an investor or shareholder actually want to own the slower Elon Musk vehicle, being Tesla, right? Because if you look comparatively, SpaceX offers 73% revenue growth, 8 billion of profit, and also direct AI and space exposure. Whereas Tesla is shrinking. You see their revenue declining. Not only that, their margins are also collapsing, and then leading to the bottom line shrinking as well. And a lot of their AI, and robotics, and also full self-driving ventures have not been proven yet, and they're not even generating any form of much of revenue or contributing to bottom line. If anything, they are spending more and more OPEX and CAPEX to get it up and running, but nothing is proven yet. So SpaceX is also targeting the same retail allocation, the same retail base that owns Tesla. So most people that are potential SpaceX investors or shareholders already own Tesla. So we believe that there would be very direct wallet share competition from June 2026, which is when we expect SpaceX the IPO to begin. And another thing that I'd like to point out is the AI. So a lot of people are buying Tesla as part of an AI company. But now if you look at that Tesla or Elon Musk's AI, which is XAI, and more particularly Grok, it sits inside SpaceX, right? Not Tesla. So if you think about it, the AI optionality, that has sort of helped to prop up Tesla's very high premium is been migrated to a different platform, and more importantly, a different stock counter, which now, it's going to be publicly traded. So what we believe is that Tesla's Musk premium, which is what everyone's paying for, is now without, his best assets like his AI and space. So we believe that there will be a big re-rating risk for Tesla. We do still have a sell call and a target price of $215 for Tesla. Now moving on to the next slide. Yeah, so Iqban, I'll be handing it over to Fahmi first for the software. Thanks.
Yeah, thank you, Glenn. So I'm presenting on the software where we think the fundamentals of the software companies are still intact, regardless of the AI disruptions that we are having in the market right now. Next slide, please. So among all the upcoming IPOs, these three are the most important in the US market. We think OpenAI, Anthropic, and also SpaceX, which also include Grok. So we believe that these three IPO would uplift the US tech industry, which would benefit from the IPO raise, which is the capital market. We believe the IPO process will provide sufficient capital to meet these companies' obligation, which will begin mostly in 2027. We believe it will be a turning point for the broader tech industry if they are able to commit to these commitments in the first year. So some of these companies that would benefit are like the cloud providers and also the GPU providers, as shown in the slide. You can see it up there. So NVIDIA and significant industry as well. We believe that OpenAI and Anthropic are likely able to meet their commitments through a combination of private and public listing funding. OpenAI may has around 220 billion US dollar by the year end to pay less than 100 billion US dollar of commitments in 2027, while Anthropic may has about 136 billion US dollar to pay less than 50 billion US dollar in commitments. So these are just our conservative estimates, and there's a possibility of these companies raising higher fund in the IPO, banking on the recent strong growth shown, for example, like Anthropic, surge in annualized recurring revenue growth that they gave out just in the recent month. So SpaceX has lower exposure to the cloud and GPU commitments, but a successful IPO from SpaceX in June, if they are able to raise their targeted IPO fund, it would be a positive precedent for the OpenAI and Anthropic, which would be positive for the tech broader market as a whole. Next slide, please. Next is on Microsoft. So the upside for Microsoft will come from the OpenAI and Anthropic IPO as explained earlier, because they are the main player in the cloud provider field. So the big bulk of the Microsoft backlog order, which is at 250 billion US dollar, is from OpenAI, which is a multi-year contract and which is expected to begin in 2027. But on the other hand, we are looking at the software side of the business, which is making about a third of the business or more than that. Microsoft is highly dependent on the number of seats, as its revenue per seat is relatively low compared to the other software companies at around $1,000 per seat, if you compare with the other software company, which is usually at millions per seat. Therefore, a reduction in seats due to the industry-wide layoffs that we keep hearing about from the market would negatively affect the Microsoft. However, we believe the software side of the business will remain resilient amid the global layoff. As you can see from the chart, that this is the software side of the business, which is the productivity suite revenue. You could see that the yellow line chart is trending upward, which is their margin. The growth is growing high as well, as indicated by the blue bar chart. So regardless of the recent AI that is surging right now, the trend and all, you could see the growth is still there and the margin is still trending upward. So what is going to happen in the software suite? Microsoft is planning a broad-based price increase across all their pricing tiers, which is their subscription. So which is also along with the new bundle package, which is called E7, which is their new premium package for their enterprises customer. So this package would combine Copilot and other products of AI. And in our view, it would help to accelerate the adoption of their Copilot, which is their user interface AI products, would help their software business going on forward, even amidst the global layoff which would affect their stakes in the long run. So we have a buy call for Microsoft at $540. Now we will pass over to the next presenter. Thank you.
Thank you, Fahmi. Good morning, everyone. I'll present a digital ad segment in which I title American Next Top Large Language Model. For this segment, we think that the companies will focus on LLM performance and accuracy in order to push recommendation and conversion because advertiser they should expect AI to deliver a hyper-personalized ads to the user. So from the cartoon on the left, you can see that there should be a train of thought behind this recommendation based on user activities, and these will actually follow a further revenue generation. Next slide, please. So moving on for Meta, we think that the theme for the company has transformed it from scroll to super intelligent. So the chart actually shows a positive operating income growth while the margin is slightly volatile at the moment. Time spent by the user will remain quite important in our point of view, but we think that the content generation and ad efficiency the main key to keep the user engaged, as in it will result with an user action such as like clicks and like, and it will help to validate our Meta hyper personalization strategy. So we think the differentiated AI functions such as like translation, edit, and also of course Meta AI will help to drive the content generation. And then continued conversion efficiency gain should also support the advertiser demand, especially the company is now merging Llama with the recommendation model. So we think that the capex spending at the moment remain quite acceptable because the operating income continue to grow, is showing on the left side of the chart. At the same time, the free cash flow is growing around like 7% year on year. But we think that margin might be squeezed on the short-term basis because of the current spending momentum, and also do expect a higher cost as well. But longer term, we believe that building the in-house chips while maintaining a partnership with chip makers and also energy provider is a very good strategy for Meta in diversifying the supply chain and energy sources, considering that based on the overall macro situation, there might be a potential constraint. Yeah, so for Meta, we have accumulated rating with target price of $825. So next slide, please. Moving on to Alphabet, we think the development of agentic commerce will evolve the company beyond searches. If you look at the chart, we believe that both operating income will continue to grow and margin will remain resilient because of the strong performance in the Google Cloud business. We believe that the current Gemini model demonstrate a very high inference capacity in adoption. It now process like over 10 billion tokens per minute compared to the competitors ChatGPT at 6 billion. At the same time, Gemini integration into search is also showing a result on engagement because the queries now is 3 times longer than traditional search, and 17% of them of the interaction are actually using multimodal input such as like voice and also images. We think that it should be helpful for further LLM training to optimize the ad targeting with the higher understanding of user intent under different modes because the prompt are becoming more complicated. Yeah, so despite the ongoing Middle East conflict, we also see the initial plan of data center build up to continue in order to have more compute capacity. Therefore, beside the short-term margin pressure, we think the current growth, we also think the current growth of hyperscaler backlog might also hurt the revenue realization on the short-term basis because of the capacity constraint. So maybe on the short term, we do see a potential effects on the short-term market sentiment, and also it will reflect it on the share price as well. Next slide, please. Thanks. So lastly, for OpenAI and Anthropic IPOs, we do expect more capital inflow will intensify the LLM competition, but think that it could have a positive impact on Google Cloud business because of the rising demand of compute capacity. And of this company, they are currently pushing for diversifying the supply. And we also do think that the IPO could help with Alphabet valuation because the market will start to price in high quality LLMs, including Gemini as well. And we also expect an expanding data licensing deal between OpenAI and Reddit because high volume user behavior data is very much needed to train GPT, because the company doesn't really have a search business, and therefore they have a less access to first-party data like Alphabet. And at the same time, we do expect a future partnership from Anthropic with Reddit, despite there is an ongoing lawsuit between both the company about the unauthorized uses of Reddit contents. And both of which we think that it will help to utilize Reddit Business Edge, which is a structured community, in order to diversify the revenue. Yeah, I think that's all from me. I'll pass on to Helena. Thanks very much.
Thank you, Serena. I'll move on to talk about the e-commerce sector. So retail sales have still been really flat. Next slide, please. So if we take a look at the retail sales, it has been flat since 2021. Its latest growth was 3.6%, which is just slightly higher than inflation. So in other words, it's just barely keeping up with inflation. So the reason why US retail is flat, the first is, of course, the consumer spending fatigue, especially after the post-COVID period. Households are becoming more selective. They're trading down and delaying purchases, looking for better deals. And also, interest rate is still high. Even with the rate cut expectation, the real borrowing costs remain very high. And last but not least, the cost of living is still pressure is very high. Even though inflation has cooled, the pricing is still elevated if you compare it to the 2021 and 2022 period. So there are key drags in terms of housing, food, and insurance. So people have less discretionary income for them to spend. And of course, with the Middle East conflict, it's definitely influencing the entire e-commerce section with cost pressure because higher oil price, higher logistic and shipping costs, and also there are some supply chain disruption. So all these require the e-commerce players to expect for longer delivery time, and then they need to build up for higher inventory buffer just in case. Moving on to the next slide, we're going to talk about Amazon. So Amazon, we always think of it as a e-commerce defensive stock whenever things go bad because Amazon, it has the skill and logistics, so that gives them a better cost absorption compared to their peers in terms of bad periods. So they have better shipping cost optimization, they have higher supplier negotiation power, so they're able to protect their margins better than the small players. And second, it's because recently Amazon has been shifting its focus to low value good, convenience good. So their positioning is more catering now to now people are trading downwards. So it's more of competitive pricing and more of the daily essential goods and broader product selection. So people are going to order from them more and more frequent. So all these are going to help Amazon in terms of bad periods. And also Amazon is not really just a e-commerce company anymore. It's more diversified to AWS now. So there has been doubts on Amazon because its AWS growth has been slowing down a little bit in earlier quarters, and that sparked questions about whether the cloud business is overrated, whether it's worth to keep pumping money into the business. But starting from the last quarter onwards, AWS growth starts to reaccelerate again, and in the most recent quarters, it actually grew 24% year on year, which is the fastest pace in 13 quarters. So that kind of answers the question that even though they're spending a lot of money, they are slowly seeing those investments to translate into revenue. The demand visibility is still very strong. Their backlog grew 40% year on year. And like my colleague mentioned earlier, the OpenAI and Anthropic, Amazon has invested in both. And in exchange of that, OpenAI has committed to around $100 billion of cloud spending on AWS over the next 8 years. And Anthropic has also designated AWS as its primary cloud provider. So all these will add up to AWS demand visibility. So right now, Amazon is still spending a lot on their CapEx. They are seeing a lot of demand coming in, and they are committed to build their infrastructure as fast as they can to cater to those demand coming in. So overall, we remain positive on Amazon. We have a buy recommendation with 280 target price. Moving on to the next sector, which is hardware. So we are seeing rising memory costs putting pressure on margins. Next slide, please. So memory cost, it accounts for about 15 to 25% of the total BOM. So there's definitely a pricing versus demand trade-off. And right now, because the overall demand environment is rather weak, so there's very limited ability to pass that increased cost to the buyers. But of course, the premium segment, who have a stronger pricing power, they're definitely more resilient when it comes to such effect. Move on to the next slide. So I'm showing a graph of the global smartphone market. We can tell that the yellow part is actually Apple and the blue part is Samsung. So Samsung at certain period, it was exceeding Apple, but in the fourth quarter, we can tell there's a sharp increase in Apple's market share to 25%. So this is because Apple, they had a very strong last quarter. In fact, the strongest quarter they have in a very long time. This is because of the rollout of their iPhone 17. So the last strong iPhone cycle we see was actually in 2021. So that was more than 4 years ago. So if you really think about it, it's a reasonable amount of time for people who bought the phone in the previous cycle. Now it's the time that they're thinking of upgrading their phone again. It came a little bit shocking actually because there's no major upgrade and Apple was actually lacking a lot in their AI capabilities. So the only explanation was because of the last cycle was about more than 4 years ago. And also for the iPhone 17 rollout, the most basic model, it was the same pricing as iPhone 16, but the storage was double. So that kind of attracts a lot of people. It is so strong that Apple didn't even see it coming as they didn't have enough stock to meet the demand. They've also guided a very strong growth for the next quarter as they're seeing a lot of demand piling up. They're trying to meet up demand in the next quarter. So which is why we see the huge spike in their market share. But we can already see that in the most recent quarter, it already went down a little bit. It's still in front of Samsung, but it's already fall to 21%. So overall, we think the stock is still in a prove-it phase, especially it has a pretty high forward PE ratio. And for a company that's not been growing so much, it's considered really high. So whether Apple is able to sustain this iPhone-led growth, it really depends on whether their Siri rollout is going to be critical enough for them to catch up in terms of their AI gap. So overall, we're still cautious. We have a neutral rating with a target price of $260. Now I'll pass my time to my colleague.
Yeah, hopefully the audio is fine. Yeah, so for the semicon, Iqbal is currently out for a site visit, so I'll be helping him to present for the semicon sector. Next slide, please. Yeah, so this basically shows all the incoming AI IPO companies, that have deals with the semicon processor companies. So we believe that the 2026 IPOs, at least this year, will act as a catalyst. So for example, we take the biggest one here, which is OpenAI. They have signed a 10 gigawatt multi-year deal with NVIDIA to build AI data centers from the second half of the year. So for context, 1 gigawatt, so 10% of that can power 1 million homes. So this is almost all of Singapore's residential energy consumption. So you imagine you just 10x that. That's the size of that deal. And we estimate that the 10 gigawatt deal with OpenAI will provide revenue potential of around 300 to 400 billion US dollars across the next 3 to 4 years. So that's basically just locking in the amount for these companies. And lastly, we also expect that these IPOs will act as a catalyst for the semicon companies due to greater emphasis on high-end semicon processor chips to run these AI workloads. Now, moving on to the next slide, we'll be looking at we believe that there is quite broad optimism for semicons. So this chart shows the SOX, which is the semicon index, and versus the Nasdaq, right? The red line there is what we use to basically track the semicon price. So share price, sorry. So the SOX and the Nasdaq has historically have quite a strong correlation. So you can see, it does track quite closely to each other. But recently, from January to February of this year, it did diverge, due to a surge in the memory ASPs, and it also fueled optimism for memory-related counters such as Micron and SK Hynix. And very recently, on 8 April, it did cross the all-time high, and it has continued to climb higher to reach $415 on 17 April. So this all translates, to broader optimism across semicon counters such as processor, equipment, and memory companies like NVIDIA, AMD, Broadcom, and as well as TSMC. Moving on to the last slide for the semicons, we have NVIDIA. Yeah, so NVIDIA, this is its deals that they have, since 2025 all the way to today. So all the deals that they have they have, positions them to capture future AI demand in both the agentic as well as physical AI. And especially, deals with Marvel Tech and Sci-Fi enables NVIDIA to create IP as well as design custom AI chips for their hyperscalers, which are also creating more in-house custom chips to maximize their token per watt performance. Particularly, their fourth quarter free cash flow for NVIDIA did spike by 125% year-on-year to a record of 35 billion. And this, just gives them strong balance sheet to acquire and also make further deals with companies that are involved in both the agentic and physical AI for the future. So we have a buy rating and a target price of $220 for NVIDIA. Yeah, now moving on to the next slide, we'll be doing the banks. So all three banks released their results last week. So we did, publish and also give an update for all three banks. We'll start off first with JP Morgan. So our title is Records Markets Revenue Offsets their net interest income guidance trim, which I guess was the biggest negative for this quarter. Next slide. Yeah, so for the brief overview of their results, their first quarter PATMI rose by 13% year-on-year. It did beat our estimates slightly, and the first quarter came in at around 27% of our forecast. It was mainly driven by record markets revenue as well as strong investment banking fees. So net interest income still continued to rise by 9% year-on-year, despite the margins declining by 8 basis points, mainly from the higher deposit as well as revolving card balances, and also supported by loans growth of 11%. The non-interest income revenue was the one that really led the earnings. So it was up by 11%, mainly led by record markets revenue, investment banking fees, as well as asset management fees. The main negative that we have seen, is that their expenses have continued to outpace their expense growth, has continued to outpace revenue growth. So if you look at non-interest expense, it rose by 14%. It outpaced the 10% revenue growth. And we're also seeing the overhead ratio being up slightly to 53% as compared to 51% a year ago. And more importantly, the biggest negative of this quarter and what really, I think, hit the share price was that they lowered their net interest income guidance. So their FY26 total net interest income guidance was lowered to 103 billion from 104.5 billion. And the main difference was that the market's net interest income the guidance did decline to 8 billion and is expected to be offset by non-interest revenue. So the reason why they gave this lower guidance was the shifts in deposit behavior and also competition for yields as we are expecting the Feds to hold the rates. So actually, if you think about it, the Feds holding the rates higher for longer, it is detrimental for JP Morgan. But on the other hand, if you look at their expenses wise, it has not been changed. So they are still expecting 105 billion for FY26 expense guidance. And also their card services net charge-off rate is also still at 3.4%. First quarter came in around 3.47%. So relatively stable. We upgrade to an accumulate from a neutral with a higher target price of $335, mainly from raising our earnings by 4% from higher principal transaction and investment banking estimates. So we believe that the first quarter earnings does mark the start of a durable recovery in fee income. We are seeing that the M&A and ECM pipeline reopening will continue to drive the investment banking fee income for the rest of the year, and also asset management tailwinds. Like we're seeing AUM up by 16% year-on-year, and the resilient consumer balances will support both AWM and CCB segments. Yeah, so that's all for JP Morgan. Now let me move on to the next US bank, which is Wells Fargo. So Wells Fargo, we are seeing that their post-asset cap momentum has started to build across all of their segments. Next slide. Yeah, so for Wells Fargo, brief recap on their earnings. The first quarter earnings rose by 7% year-on-year. It did come in slightly below our estimates, at 23% of our forecast. Revenue rose by 6%, mainly from net interest income growth as well as non-interest income growth. And we saw that all segments delivered year-on-year revenue growth. The non-interest income has continued to support their earnings momentum. It was up by 8% year-on-year, mainly led by investment advisory fees, markets revenue, as well as card fees. The net interest income growth came from loans growth of 10% and also deposits rising by 6%. More importantly, their guidance has not been changed. So their FY26 net interest income guidance of 50 billion and also expense guidance of 55.7 billion has been maintained. Yeah, just go through some of the main highlights and also outlook that we're looking at for Wells Fargo. Most importantly, I think this quarter was that they did close their final outstanding consent order in March of this year. So it completes the resolution of all 14 orders since 2019. So now with the removal of the June 2025 asset cap, that they had, they are basically operating without any of the regulatory constraints that have sort of suppressed their positioning for the last 10 years or nearly a decade. And the first quarter does give very early evidence that this is translating into operating momentum. So we are seeing loans up by 10%. Their new credit card accounts are also up by 60%. And their auto originations have also more than doubled. And all four segments of Wells Fargo has delivered year-on-year growth. They also maintain both their NII and expense guidance. Yeah, we do upgrade to a buy from an accumulate with an unchanged target price of $90, mainly due to the recent share price performance. But all our estimates remain unchanged. So the closure of their final consent order and the post-asset cap balance sheet expansion are translating into operating momentum. And now with all the 14 consent orders resolved, the asset cap removed, and continued loans growth, we are seeing that Wells Fargo is entering a phase of normalized growth. The revenue diversification is also improving. We are seeing where WIM and CIB markets both up by double digits, and also consumer banking up by high single digits. Out of all the US banks, I think I'll get this question maybe later, but we like Wells Fargo the most, mainly for these reasons that I stated above, and also now that they do have some like a kicker to kickstart something that they were sort of suppressed for the last decade or so. Now moving on to the last US bank which is Bank of America. Yeah, so we are seeing that operating leverage has delivered the bottom line growth for Bank of America. Yeah, next slide, please. Sorry, excuse me. Yeah, so for the first quarter, earnings it was up by 17% year-on-year, and it came in slightly above our estimates at 26% of our forecast. The revenue rose by 7%, and it helped to generate 290 basis points of operating leverage. As we saw that expense growth did lag this revenue growth. So revenue grew by 7%, but expenses only grew by 4%. We also saw that their efficiency ratio has improved by about 170 basis points to 61%. And almost every segment has contributed to year-on-year net income growth. The net interest income rose on global markets activity, fixed rate repricing, and also deposits and loans growth. And we also saw that sales and trading rose by 13% year-on-year with a record equities revenue, which was up by 30%. And IB fees had also jumped, investment banking fees had also jumped by 21%, and asset management fees did show strong growth of 15%. Their guidance was raised, so they are, I think, the only US bank amongst the three that we cover that raised their guidance. And it was raised from 5 to 7% growth for net interest income to 6 to 8%. And their FY26 expenses are expected to grow at a slower rate of 4%. So we will still see that operating leverage help to deliver more bottom line growth going into the rest of the year. In terms of the outlook, we are seeing that the operating leverage is a real structural earnings engine. So like what I said, the revenue growth of 7% will help to outpace the expenses growth of 4%, and this will help to drive the efficiency ratio. And furthermore, they have also increased their net interest income guidance, mainly from continued fixed rate asset repricing and also balance sheet growth. We do maintain accumulate with unchanged target price of $60, so our FY26 earnings remain unchanged. The strong PATMI growth as well as the operating leverage does reflect the earnings power of Bank of America's diversified business mix, and they have contributions from record earnings, record equities trading, investment banking fee recovery, and also asset management growth. And we expect the main drivers for growth in FY26 will come from the higher net interest income, continued wealth management fee expansion, higher global markets revenue on the heightened volatility and also disciplined expense growth. So that's all for the US banks. I'll now go to the Max 7 monthly. So this will be a bit, there might be some repetition or repeat because we did cover the US SSP summary, but just bear with us. I think there will be some also news, regarding whatever happened in March for each of the counters for the Max 7. Next slide, please. Yeah, so for the performance in March, it was quite dismal. It was in March, the share price for Max 7 fell by 5%. It has continued to underperform both the S&P 500 as well as the Nasdaq. And we believe that the decline mainly came from the escalating Middle East geopolitical tensions, which helped to push the Brent crude oil, towards the $100 mark, and also some landmark social media activation court rulings in late March. So that affected Meta the most, and also a continued market reassessment of aggressive AI capex versus near-term monetization. In terms of the Max 7 counters, which pulled back, actually all the Max 7 counters pulled back this month, and Meta was the biggest laggard, mainly from that court case. And I think Serena will go into more detail later when she covers Meta. Next slide, please. Yeah, so for Tesla wise, some repetition here because I did talk about their deliveries growth. So it has been very weak, right? We are seeing it continuously decline for the last 3 quarters. And just to highlight, the first quarter 2025, which is what we used to compare year on year with the first quarter 2026. The reason why we saw an increase year on year for first quarter 26 was because it was coming from a very low base in first quarter of 25, where they had that Juniper Model Y turnover. So they actually paused changeover, and then they had to pause production on all four of their factories. So this affected their production and in turn also affected their deliveries, which is why they didn't have many deliveries in that first quarter. So if you look at it, it was probably a year-on-year decline if you remove that factor. We do expect that the deliveries will continue to decline, mainly from the removal of now the EV tax credit, and also a lot of competition from the auto car makers. Even in the US, right, where they don't really have much competition from the Chinese EVs, but they still are facing competition from the other car makers like Ford, Hyundai, and etc. In terms of China, which is their second biggest market, it has continued to crash. We saw sales drop by 24% year on year. And more importantly, also their market share did continue to dip. It was at 5.7% versus the 5.9% in the previous month. And it's the lowest we have seen in 29 months. So BYD's, interestingly, if you look at BYD, which is the biggest EV car maker in China, it did stabilize as well, right? We saw their deliveries fall by 11%, and market share has also dipped slightly, which just goes to show that a lot of the other car makers like Xiaomi, they are up and coming, and they're also taking market share across the board from not just BYD but also from Tesla. So yeah, we do maintain our sell recommendation and also a target price of $215. Next slide. Yeah, I'll be covering for Iqbal again for NVIDIA. So for NVIDIA, the biggest news this month was that they invested $2 billion in Marvell, which is the biggest deal that they had since January 2026. And this deal allows us enterprises to connect Marvell's custom chips to NVIDIA's AI ecosystem to develop semi-custom AI infrastructure. And the semi-custom chips will then allow enterprises to reduce their power consumption by optimizing performance per watt. And this is all the more important now, especially with the rise in electricity prices. And secondly, they also had a deal with Sci-Fi, which allows NVIDIA to create IP blueprints to create tailored AI chips. And this is possibly to meet the demand in both agentic as well as physical AI. And we believe that NVIDIA does want exposure in the custom AI chip space, and this will compete with Broadcom for huge hyperscalers as their main customers. So we do have a buy call and a target price of $220 for NVIDIA. So I think that's all I have. I'll now hand it over to Fahmi, who will be covering Microsoft. Thanks.
Maybe I go first. Next slide. Yeah, so Apple, not much from Apple. So they announced that they're going to use the Samsung's display exclusively for their foldable iPhone screen. They have entered a 3-year exclusive agreement with Samsung. The reason they're saying they can't find an alternative vendor that is able to meet the specification that Apple wanted. So the foldable iPhone, also in the beginning they were saying there's going to be a delay, but then subsequent report came out that they say they're going to be able to make it on time. So this is definitely a major product line extension that they've been working for years. It's part of their multi-year effort to refresh the iPhone's form factor, but we think it's unlikely to replicate the original iPhone level disruption, given that foldable is nothing new in the market already. Their competitors have been coming up with it ways before them. So apart from that, like I mentioned earlier, they're still facing cost pressure from rising memory prices. So Apple really needs to demonstrate consistent product-driven growth and tangible progress in their AI, which they currently lack, in order to support its premium valuation. Next slide, please. Moving on to Amazon. So Amazon indicated during internal all hands that advances in AI could drive their cloud unit AWS to scale its revenue to around 600 billion by 2036. So that's going to be a CAGR of around 17%. Another thing is Amazon has rolled out their 1 hour and 3 hour delivery options for select items. So the pricing wise, for Prime members, it's going to be $9.99 for 1 hour delivery and $4.99 for 3 hour delivery. And for non-Prime members, it's going to be more expensive. So this is also another strategy that they're using to try to get people to sign up for their Prime membership. So overall, like I mentioned earlier as well, very strong backlog, very strong growth, and for the AWS side and on the retail side, the rollout, they're still trying to find out new ways to try to improve their customer stickiness and to make sure that the people who are not using their platform are going to start using it, because now they're catering to the people that want goods to deliver right away. So these people usually they don't want to do e-commerce, but because they develop their delivery speed so fast, they're trying to tackle that part of the customer as well. Yeah, so that's all from me. I'll pass my time to the next presenter.
Hi everyone, so this is for Microsoft updates. It's a bit of repetition as well because I already presented this in the previous SSB slide. But in March, Microsoft introduced their new premium packages, which is Microsoft E7, which is a new premium packages plan for the enterprises. In that plan, it's being sold at $99 per user per month for enterprise user and will launch in May. It would include the Copilot as an add-on and also AI features such like adaptive city management tools and the new agent to better manage the company's AI agent. So this new plan is 65% higher than the E5 subscription after the upcoming increase, even after the upcoming increase in June of 2026. This would affect many organizations in many sizes, including large enterprises and SME. So when Microsoft bundle together Copilot and Agent product at a discount rather than as an add-on, we think this might help Microsoft to accelerate adoption and support growth while offsetting the seat-based decline that we are seeing in the market right now amid the layoff. Because the more people are being laid off, it is the general assumption that Microsoft would be making less money in the near future. And Copilot conversion is currently, if what we are seeing is remains low at 3.3%, which they have about 15 million out of the 450 million users that they have since 2023. And we do think that the competition is intensifying when we look at the main competitor, which is Google Workspace, which are seeing, in our view, faster adoption in their Gemini product. But still, we maintain a buy recommendation for Microsoft at an unchanged target price of $540. We see long-term earning visibility, which would remain supported by their 625 billion in commercial IPO. And not to mention, just like mentioned earlier in the previous presentation, the big part of the order would come from OpenAI order, which is $250 billion US dollar, which we are positive on that they would be able to pay off the commitment starting in 2027, right? And then the share price fell about 6% month-to-month basis to 370 US dollar. Pressure is coming from higher than expected capital expenditure and near-term margin concern, AI-driven disruption, and declining seed demand amid the industry-wide layoff. So that is all for me. I will pass over to the next presenter. I think Serena. Thank you for my time presentation.
Thanks, Fahmi. Good morning, everyone. Let's start with Meta. There are actually two lawsuit verdict against the company about the design of their platform. So for those who are not familiar, I mean, there is a jury in Los Angeles actually found Meta and YouTube, which is under Alphabet, liable for the harm caused by the platform very addictive design. So the company, as in Meta, it was ordered to pay around like 4.2 million in damages to the plaintiff. So for this case, Meta was actually assigned around like 70% of the liability. And Alphabet will actually bore the remaining 30%. For another case that the jury in New Mexico actually found Meta liable for enabling sexual predators to target children on Instagram and Facebook. So for this particular case, that the company was ordered to pay 375 million in civil penalties. But we think the long-term impact, I mean, we think overall the impact still remain uncertain, because the long-term impact will really depends on whether regulators actually steps in and ask the business to have the change the platform features, and also to change the business practices as well. Next slide, please. Moving on to Alphabet, about the AI partnership, Broadcom will actually supply of Google with the customized TPU, while Anthropic will also has also announced a deal with Alphabet and Broadcom for multiple gigawatts of next generation TPU capacity, and starting next year. Like I mentioned before, all of these companies nowadays, they are trying to diversify the supply chain. So we think that the collaboration between Broadcom and Anthropic, we view it positively, because we think it could position Alphabet's customized chips as a viable large-scale alternative to NVIDIA GPU. And then at the same time, we also see TurboQuant, which is an algorithm designed to reduce the amount of memory needed to run LLM by 6 times, will actually helps to lower the AI deployment cost and also boost the enterprise adoption. And at the same time, we also see that it will help to boost the efficiency, considering that there are so many backlogs among all the hyperscaler. Next slide, please. So overall, we maintain overweight on Max 7, and we see the valuation the most attractive in over a decade. At the moment at 22x forward PE, because of the resilient AI demand and also a very strong cash flow in all the Max 7 company. We also believe that the current sell-off is pretty technical because of the current Middle East conflict, and we see the fundamentals remain intact. And we also do believe the upcoming mega IPOs like Anthropic, OpenAI, and also SpaceX actually to further justify the Max 7 AI spending. Yeah, I think that's all for Max. I'll pass the time back to Helena for Netflix, I think. Yeah, thanks.
Thank you, Serena. I'll keep it short. So Netflix released their earnings last week. Both revenue and PAMI were in line with expectation. Their PAMI was affected by the 2.8 billion termination fee related to the Warner Brothers transaction. So they've shown very strong pricing power. They've recently increased their price again. The price increase is about 8 to 13% across different plans. It's very well absorbed. Early indicators all point to very stable retention and churn. And right now, Netflix delivers one of the lowest cost per viewing hour among all the streaming platforms. So that support further pricing headroom for them if they ever want to increase price again. The second one is their ad is on track to doubling. So they have guided that they're going to double the ad revenue in FY26, and now they confirm that they're able to do so. It continues to scale, supported by ad tech capabilities and a rapid expanding advertiser base. So right now their advertisers are more than 4,000, so that is a 70% year-on-year increase. The ad-supported tier remains a key entry point for Netflix right now. It accounts for more than 60% of the signups in the ad market. And they're delivering engagement levels that's comparable to people who sign up for ad-free plans. And in parallel, they're also trying to invest in its proprietary ad tech stack in order to enable better targeting and to improve measurements and new ad formats, which is attracting a broader pool of advertisers to drive monetization efficiency. But some of the bad things, their growth outlook moderated a little bit. So they've guided for 12 to 14% year-on-year revenue growth, which is a slight decrease from their previous higher growth levels. And now their growth is increasingly supported more by pricing actions and ads expansion rather than subscriber growth as they focused on before. We think it's a natural shift towards monetization. It's just part of a neutral evolution. But even though recently their price hike has been well absorbed, we do have concern that if they keep on doing this, maybe at some point it can cap the upside if their engagement or perceived value weakens. Last but not least, because they terminated the Warner Brothers deal, so definitely they missed an IP expansion opportunity. It removes a catalyst for them to rapidly scale their ownership of premium globally recognized IP, which could have strengthened its long-term content mode and reduce its reliance on third-party licensing ahead. But that said, management keep on emphasizing that the deal was nice to have, but not need to have. So we believe the impact is manageable given that they're continue focused on the original content and they have a very diversified global slate. Going forward, they say they're still going to be open to merchant acquisition, but only when the returns are clearly attractive. So I think the Warner experience likely make them more disciplined in terms of choosing. Moving on to guidance, I mentioned earlier, they've guided for 13% year-on-year in the second quarter. They've also expect operating margin to decrease a little bit as their second quarter is usually the highest year-on-year content amortization growth. So all in all, we think they posted another strong set of results. Pricing is increasing with minimum churn. Monetization has been improving constantly. We view Netflix as a clear leader in the streaming industry right now, supported by its ability to consistently deliver through a combination of high quality content and flexible pricing. The company maintains a significant scale and monetization advantage. Right now, they stopped announcing for their subscribers, but last quarter during the year end, they've sort of mentioned it. So it's around 2.5x as many subscribers as their closest competitor, which is Disney, and they monetize it twice as better. So which kind of reflects its superior engagement. With regard to their Warner Brothers deal, the management keep on reiterating that it's nice to have, not need to have. So that kind of underscores the confidence in their current existing model, which is primarily driven by original content. We maintain our accumulate recommendation with a slightly higher target price of $110. We do raise our revenue and PAMI by 1% respectively to account for the price increase. We decrease our WACC slightly due to the risk being moderately declined because of the termination of the Warner Brothers. Yeah, so that's all from my sharing. I'll pass my time to Darren, I think.
Yeah, thanks, Helena. Yeah, run through Keppel DC REIT's first quarter 2026 business update. Yeah, so in the first quarter, they had very strong rental reversion. So it continues from the 45% last year. So this year it was 51%. But one thing to note is that there weren't many renewals this past quarter. So only about 0.3% of total leases. But it still shows that the market is still very strong and the reversion potential is still there. But we do expect to be lucky generally. Yeah, so just looking at the numbers of the first quarter 2026 results, the performance was strong, 13.2% DP growth. It's mainly from the contribution from the acquisitions of Tokyo DC 3, which completed last year. So first quarter is a full year contribution, as well as higher rents, as well as the additional stake in SGP 3 and 4 as well. So for the Quantum DC side, they continue to recognize losses. So up accumulated to date is about 55 million that is still in unpaid rent. And yeah, I see a question from CK. It says, yeah, you're right that the finance costs increased because of the acquisition loans. But these acquisition loans were drawn in the fourth quarter. So this was mainly to fund the acquisition of Tokyo Data Center 3. And yeah, and DPU grew so much by 13.2% is because Tokyo DC 3 was really an accretive acquisition. So as it contributed to the first quarter, yeah, it's basically you get a higher DPU as well. Yeah, so generally in line, the results for this quarter was in line with our expectations. So occupancy dipped just 0.2 percentage points, but that's mainly from non-DC space downsizing. And yeah, like I mentioned, the rental reversion is also very strong. So for the cost of debt, even though like you rightfully pointed out that the finance cost increased, but the overall cost of debt it actually declined by 20 basis points to 2.6%. Yeah, and they remain 85% hedged. So leverage still remains healthy, and they still have about 550 million to debt headroom to 40%, which is their internal cap. So they are still looking at acquisitions in this current environment. And yeah, and for the negative for Keppel DC REIT is the continued weakness in the quantum DCs. So they continue to recognize the loss allowances for unpaid rent. So the bottleneck, the feedback that they received was that uh, there's a bottleneck in chip availability. So that's really the issue for China. Yeah, so for the impact of higher utility cost from the Middle East conflict, so it's not really significant. So right now, Keppel DC's utility cost only accounts for about 3% of OPEX, of total OPEX. So it's really minimal, and the rest of it is actually passed on through to tenants. So the impact will be more second order as tenants they face higher operating costs and occupancy pressures as costs rise, and which could in fact impact the potential of positive rental reversions in the longer run as well as the rental negotiation. So this is very in a longer term. Yeah, but also like I mentioned that Keppel DC will continue to look out for accretive acquisitions. So mostly in established DCs hubs like Japan, South Korea, and Europe, and they focus on hyperscale customers. Yeah, so going forward in FY 2026, we still do expect DPU to grow at a similar level because of the contribution of the full year contribution of Tokyo DC3. Yeah, but for 2027, if you want to look at DPU growth is more reliant on whether they will have any potential accretive acquisitions in 2026 this year. Yeah, so I think I've answered those questions from CT as well. So yeah, no change to our target price and our recommendation. So Keppel DC REIT, they're still paying a forward yield of about 4.6%. So considering it a REIT, so we think at 4.6 is just not as attractive as other REITs that are paying higher yield. Yeah, so that's all for me. I'll hand over to colleague Serena. Thanks.
Thanks, Darren. Hello again. I will present Phillip on the ground on Kin Global Limited IPO. Some people might know it, might know the company as Kin Production before the restructuring. So for those who are not familiar with the company, it is Singapore's largest sport event management company. They specialize in delivering the sports experience and also some events beyond sports, especially in museum, galleries, and also theme park. So moving forward, the company will focus on event tourism, and they do see a lot of business opportunity because of the Singapore international visitor arrival continue to grow, and they also see business opportunity because of the upcoming sports events such as SEA Games in Malaysia next year and also Singapore in 2029. In terms of the financials, for 9 months 25, the company remains profitable with nearly 4 million Sing dollar in profit, and they are having a net cash position and debt-free balance sheet. So this IPO will include a $4.4 million commitment from a diverse group of cornerstone investor, which you can see it at the bottom of the slides, and the offer price that currently is 23 cents. So 90% of the proceeds will be used to fund merger and acquisition, and also some investments such as like sports IP, so that the company could expand deeper into the event tourism value chain. So if you are interested, the subscription period will end tomorrow 12 p.m. Yeah, I think that's all from me. I'll pass the time to Zane. Thanks.
Yeah, thanks, Serena. I'll move on to the technicals. Next slide, please. Yeah, so first out, looking at the S&P 500, last week was up 4.5%, reaching new all-time highs. So I think this week wise, we are still likely to see a continued bullish momentum ahead as price is still trending above the 5-day moving average and seeing very strong momentum. The next key resistance levels are likely to be at 7,220 to about 7,320. So this is the 227 to 261.8% Fibonacci extension levels. If we look using the recent bottom at around 6,300, about there. Yeah, and support is likely to be at 6,985, which was the previous resistance in February this year, to about 7,050. Yeah, next slide. Next one, this is looking at the iShares Expanded Tech Software Sector ETF IGV, which tracks the software sector. So looking at the chart, we see that there's some signs of a bottom with a bullish reversal formed recently. So look at the price action last week, there was a bearish trap from below the $76.60 level, where price briefly did a breakdown and then recovered the next day with an engulfing candle with high volume as well. And also there was a breakout of the downwards resistance line follow after which coupled with a bullish divergence on the MACD where it made a higher low while the price made a lower low as well. So we see a potential for further rebound for the IGV towards some of the previous support level breakdowns like $94 and 100, closer to $102 about there, which is 50 to 61% Fibonacci retracement levels. If we take the previous high at close to $118 and the recent lows about close to $74. Yeah, so that's all from me. I'll hand over time to Paul for the weekly. Thanks.
Yeah, thanks. Thanks, Zin. So I'll just go through as usual some of our weekly. Next slide. As usual, we will just highlight some of the key macro data that came out from Singapore and US. So for Singapore, most of the data points on the economy are actually pretty strong. So if you go to the first one, visitor arrivals actually in Singapore picked up, especially coming up from, it's up like 10% and coming up especially from China and Indonesia. So it's quite broad-based. New home sales also jumped 78%, but as you know, this is lumpy. But year to date, first quarter is still weak, so 41% down. So this will be a negative for property agencies like Propnex and APAC Realty, because the volumes are down for new home sales. For SIA also, even though the Iranian war seemed to have benefited them, so in March, their passenger travel, that means total distance traveled by passengers rather than number of passengers, actually jumped 12%. What has happened is likely that there's been disruption to the Middle East hubs in Dubai and Doha. So a lot of passengers are using SIA to go direct to Europe rather than go through the Middle East route, from my understanding. Yeah. Singapore, MAS released their monetary policy, called monetary policy statement. I'm not sure why is it called by that way, but anyway, they did raise slightly the rate of appreciation, but nothing really much to bother us as an equity investor. I think at most, maybe the Sing dollar appreciate 0.5% higher, which is like a 1 day's equity volatility. So it doesn't really matter for us as equity investors, but again, just for information. But the big strong number for Singapore is really exports. So exports was higher 15%, electronics 74%, but semiconductor was the one that really spiked up. Semiconductor exports really jumped double. Probably this is a record rise, up 114% year on year. February was also strong, 50%, although I think it was Chinese New Year and probably nobody working, but then it still got 50% now. In the US, there was loans growth. I think one takeaway from this is that the US is leveraging up, so this will help growth rate in the US. Next slide. In terms of our tactical views, I think we all know about these headlines. Iran blocked the straits again, Straits of Iran or Straits of Hormuz, whichever you prefer. So the ceasefire will end in 22nd April. If you want Singapore time, it's 10. So generally, our base case, also our guess, is that we think Trump wants a resolution. Our overriding assumption is that losing the midterms in November this year means that he will probably get impeached by the Democrats. But he's unlikely to be convicted, because to be convicted following an impeachment of a president is that you need at least 2/3 majority in the Senate. So that's very, very unlikely. But what will happen is that there's going to be a lot of hearings in his second term of the presidency. Then there'll be investigations, release of material. So it's just going to be very, very distracting for him, and of course affects his legacy in a sense. So we still have a base case that he wants this resolved rather than send ground troops. We were initially worried, but throughout this war, he's been like backtracking whenever all his threats. So we still have this view, but again, no, this is our guess because who actually knows what he's thinking. But in terms of the sector, semiconductor is still very hot. I think if you look at ASML, so ASML is, we think, Franken's largest customer. So ASML is like a monopoly on lithography. So lithography, for those who do not know, is that on a wafer or on a semiconductor, you need to draw lines. Of course you can't use your hand. So what you use is lithography. That means like a photo of it and in nanometers. And ASML, more important, is a monopoly. So they raised their guidance. So first quarter they grew about 12%. They are guiding like 14% growth in sales for the second quarter. More importantly, we think that Franken benefits from their higher end products. And their higher end products is doing well. So their higher end products is called EUV. And they are guiding a jump of 25% in units to 60. 60 looks small, but each EUV can be 100 million, 200 million or more. So it's like a size of a factory, a cost of a factory, one machine. And then they're guiding like 33%. So the outlook for ASML is very strong because they're looking at least 25 to 30% growth in 2026 and 2027. And it's also and their highest end product, which is the high end, just think of it as the 5200 series. Is their most sophisticated, and it is coming off from pilot stage. They were piloting this, and then I think Franken has mentioned before that they are doing some like initial parts. There hasn't been a ramp, but we're beginning to see the product start to ramp in 2025. So, in a nutshell, what we're trying to say is that Franken will benefit because the ASML is turning around, the volume is picking up, and also especially for the high end, which we think Franken is focused on. The other news is, of course, MES. I think we mentioned it's a non-event. I mean, if you are an equity investor, and even the impact on US dollar is really volatile. Sometimes can be up, sometimes can be down. We'll show you a chart later. Some of the key events, I think, are Tesla, Intel's results, and the property price. And I think this week we will have Assembly Place and Nordic presenting on our corporate insights. The next slide. So this is just to show the arrivals. So far there's a slight pickup, but the one on the right is we see the blue line, which is passenger demand spiked up for SIA. So this means that if the blue line is faster than the red line, it means the yield is picking up. The margins for SIA should be jumping up because demand more than supply. So capacity is like supply. That means the amount of flights capacity or planes they added in roughly in kilometers. Next slide. Then this is exports. The one on the left here is that we took the exports of Korea, Taiwan, Singapore, and then you will see that the export growth in Asia is actually faster than even the pre-pandemic. So of course, pre-pandemic, we're talking about it's about 15%. If you look at the 2023, about 15-20%. But now exports are right growing about 40% across Asia Pacific, or at least the three key electronic exporters. So it's very vibrant electronic market. So this is Singapore's exports. So if you look at the year-on-year on the 3-month moving average, the green line is semiconductors or integrated circuits. So this is up even 80% on the 3-month basis. That means the first quarter semiconductor exports jumped 80% in Singapore. Yeah. So I lost. Yeah. The red line is just electronics, including PC and all that. So all those are also doing well. Next slide. But in terms of this is the noisiest chart you're going to see. So this is just to explain to you historically what the monetary policy MES does to the Sing dollar. So this blue line you see is the NEER, or nominal effective exchange rate. So technically, this is Sing dollar against the basket of currencies. Can be Malaysia, China, whoever we trade with. And of course, Singapore, the MES job is every day just buy. I mean, I'm just kidding. To make this blue line go up. So if you take an example, the most aggressive is usually the blue part. So if you look at the blue shaded part, just when they gap up, like a stock gap up. So whenever the blue line happens, you will notice that the dark blue line will spike up. So the last time they did it in 2023, because inflation was so strong in Singapore, they gapped up the exchange rate. So that's usually the most aggressive. They gap it up a few times. Most times it's just very gradual, maybe 1% growth per annum. But in the US dollar terms, you notice US dollar can appreciate, sometimes can depreciate. So the impact on US dollar is really mixed. So because their MAS policy is against a basket of currencies, so not just the US dollar, but I think usually against Asian currencies, that we trade with. The next slide. Okay, so this table, I know it's a lot of numbers here, but okay, so all the dates here you see is all the monetary policy statement. January, February, that's when the MAS makes a statement. So the increase slightly means they are much more aggressive, and then the blue line normally is maintain appreciation. That means just make the exchange rate stronger, hopefully against Malaysia, so we can go short more. But anyway, but the reason why they will make it green is when if you look at the far right, the CPI forecast. So the reason why they are making the Sing dollar stronger is because the inflation forecast increase. Used to be they thought inflation early this year was 1 to 2%, then now it's 1.5 to 2.5. You look at the table on the far on the right, on the column on the right. So that's why they made it a bit stronger. Yeah. And it just for information. I mean, it's your equity investor, really doesn't really make much difference for you. Yeah. Okay, thanks. I think you can move on to Q&A.
Hey, thanks, Paul. Let me take on some first. Yeah. So this one asking, among the three Yangzijiang listed companies, which one will you put in your fund if you can only choose one and their respective target prices, please? Yeah. So we only cover Yangzijiang Maritime. Yeah. So we don't cover the other two. I mean, firstly, the shipbuilding is really just a pure cyclical play on their Chinese shipbuilding order flow. So, it has benefited quite a lot, from the current cycle. But then again, it's also currently trading at peak cycle multiples, right? So there is quite a bit limitation in terms of margin of safety, right? In case something happens, and especially if the new build orders slow down. And more importantly, it's also directly exposed to the US tariff risk on any of the Chinese built vessels. Yangzijiang Financial, that one, I mean, don't really say more. I mean, their NPL ratio is, I think, I can't remember what is the exact figure, but it's really high. And also it's basically holding company that manages cash and investments, and a lot of it is still allocated to Chinese real estate. Yeah, so the property sector and the Chinese market is so a lot of overhang. There isn't really much positives for Yangzijiang Financial. In terms of Yangzijiang Maritime, I think we have said it multiple times. I'll answer another question, together with this, I think that will help to answer it quite a bit. I think it's asking how do I view the recent announcements that they had given, right? They had two announcements. So that will also answer the other question, on why we chose Yangzijiang Maritime. So the first announcement that they had on 14 April was they announced their leasing agreements. There was around $90 million across 13 vessels, mostly tankers, and this will help them to lock in the recurring income at 15-year high tanker rates. So this will help to benefit them from the ongoing, Middle East conflict, and also it does support one of our investment theses, which is the shipping cycle upswing. And the second announcement we believe is the more significant one. They released it just 2 days later on 16 April. And they basically said, they have 8 VLCC new builds, and the delivery time is from 2028 to 2030. So we are looking at, a multi-year sort of crude tanker upcycle, and also 4 MR tanker pre-sales, which help to unlock the near-term capital gains. So this will again, and more importantly, what they say is that they will use debt financing for the VLCC program. So this actually signals the first actual deployment of leverage, and will also help to push the project IRRs from 10 to 15% to 20 to 30%, so double it. So all these might actually suggest that our target price, which is 69 cents, is 1x price over book. So it might be a little bit more conservative on the conservative side, considering that they announced these two announcements. But then again, the announcements came after we released our report. So there's quite a bit of potential upside for Yangtze Maritime, especially after all these announcements. Let me just see. Yeah, there's one more here on MoneyMax. So we don't cover MoneyMax, but I did attend a few of their briefings. So it's asking, is MoneyMax placement news good? I think it's a net positive, right? Because firstly, the main reason for this placement is to hit that 15% public float requirement so that they can transfer from the catalyst to the main board. And usually what this brings, it will hopefully bring better liquidity and more visibility as well. So another point also is that the pricing, they're pricing it at 83.5 cents, right? It's quite a small discount as compared to the last traded price. I think it has increased a little bit, right, that discount. And last but not least, the funds that they're getting from this, which is around 43 million Sing dollars, it represents around 16% of their equity, right? And this is not really being used to pay off any debt or loans, right? It's 100% of it is what they say is going to working capital. So this will help to grow their pawnbroking loan portfolio and also help to expand. So the main way that MoneyMax expands would be by purchasing or expanding their retail storefront, right? They have said that, and they have actually continuously grown their retail storefront. But the one thing holding them back will be capital, because you need a lot of money, right, to invest into the time and effort to make sure that the storefront is in a good location. So this will help to go to that, and that will just help to grow their top line and also their bottom line. So I believe that this is actually a net positive. Yeah, one here asking Tesla's results going to look like. What is Tesla's results going to look like this week? Yeah, based on their delivery that they did announce, from what I say, I think you can see that I'm very negative on it. Furthermore, we're also looking at the SpaceX IPO, which is like a double whammy for Tesla, right? Their fundamentals are not strong, and then it was just riding on a lot of the hype, right? On robotics, AI hype. Yeah, but now with SpaceX coming up, right? If you want to buy not just robotics, but AI space hype, you will just go to SpaceX. But like Tesla doesn't really have anything to show for it. It's not really proven yet. You look at all of the things that they want to they're selling, right? The future of full self-driving and the Optimus robot. Yeah, doesn't look like it's anywhere close to being even commercially viable yet. Yeah, so I don't think it was going to look very good. We will probably see. I think year on year wise, if you look at the revenue or for deliveries, auto revenue, I think it might be an uptick. But then again, it's very skewed because you look at last year, if you compare year on year, first quarter 25, they had that production closure because of the Juniper Y changeover for all 4 factories. So year on year, I think you'll see a little bit of an uptick, but it will probably fall below the consensus estimates, and also quarter on quarter is going to be quite of a disaster. Yeah, I think everything is going against Tesla now. Yeah, let me see. I think there's a few more questions for me. I'll just quickly take it. Yeah, there's one here on Yangtze Financial. Yeah, I think I did say a bit about how it's mostly just on China real estate. It's not the situation has not improved. Yeah. Yeah, comparison between JP Morgan and Morgan Stanley. So I don't cover Morgan Stanley, but JP Morgan is more diversified, right? If you look at it, it's a very big global bank, right? It's not just a US bank, it's a global bank. So their revenue is very diversified, right? It's across deposit, lending, card, markets, investment banking. So it's a huge diversified play. But if you look at Morgan Stanley, it's more really a pure play on wealth and capital markets. So of course, when times are good, when you have a lot of high wealth management inflows, capital markets are improving, then you will see that Morgan Stanley might do better. But if you want something that is more defensive, right, especially in a downturn, JP Morgan would be the one. Yeah. So Morgan Stanley is a lot more volatile as compared to JP Morgan, which is a lot more stable. So it depends on your risk appetite as well. maybe I'll just take one more before I hand it over to the rest of my colleagues, which is on the OCBC. Yeah, someone asked, they attended the OCBC, and saying that, is it true that the chairman said that the dividend policy will revert back to 50% next year onwards after that big chunk of capital being distributed out to weather the current situation? Yeah, I don't think, even before this AGM, it was really more or less confirmed that they would be returning to 50%. They never actually said that they will be increasing it above 50%, right? If you look at their base dividends for OCBC, it's always been 50%. Even now, when they are paying the extra 10% and they've already paid it finished, right? It was always at 50%. So there isn't really a change. They just like to clarify that there isn't a change to this 50% dividend payout policy. Both UOB and OCBC has stuck to this payout policy, payout ratio policy, which is why we prefer DBS, right? Because they don't have this cap of 50%, right? And the reason why they gave this, I think there was a question from one of the shareholders, right, who asked out, and it was a very blunt question, basically saying, the dividends is like chicken poop, right? I censored the word. Yeah, and then they just reply and say, no, it's not chicken poop. So I don't believe it. They have the capacity, right? Looking at their CET1, which is like 15.1%, they keep saying that they want to lower it to 14%, but they're not doing any acquisitions. They're not doing anything else, right? The only way that we can see them doing it would be giving back in capital, which is over $2-3 billion of capital, excess capital, in order to make it to 14%. So what it seems like is happening now is that that's my take, is that the board and maybe the chairman is stopping that because they want to keep that excess capital in terms of, in case of bad times, right? Or like a black swan event. Yeah, so I don't think there's any change. It's just that now, the chairman has come out to say in a very public space like the AGM, to say that they are keeping their 50% dividend policy. Yeah, but then again, the CEO, the new CEO, I think hopefully maybe he will fight back more, maybe, right? He will fight for it more, and we could see some form of special dividend in the next year. Because this year we are expecting that special dividend, mainly because of the share buybacks that they may not be able to complete. So we could see that special dividend. But yeah, I don't think they will increase their dividend payout ratio above that 50%. I hope that clarifies. I've been saying that multiple times, really, actually, every time I talk about OCBC. Yeah, okay. Sorry. There's someone said, they're doing share buyback. They are doing share buybacks. So they still have around $700 million of share buybacks to be done, right? But the interesting thing is that the CEO, for the first time, I think in a long time, I've ever heard them say that they prefer special dividend over share buybacks. So in case that they don't finish that $700 million of share buybacks, right? They complete only $200 million, $500 million left over. We could see like 11 cents of special dividend coming in by the end of the year. So that's an estimate of 500 million of share buybacks not completed. And this is part of their whole capital return package that they announced about 2 years ago, right? They haven't announced anything new. Yeah, someone said about OCBC, the front runner for the HSBC retail banking business. But I don't think, I don't really know privy to how much it really costs, but is it going to cost up to $2 billion? Considering if you look at how much DBS and UOB paid for Citibank assets, and that's a much bigger, I would say much bigger, right? The amount, the quantum, and it was only like 1 billion plus, 1.5 billion, I think, for those two. Yeah, I think a lot of attention on OCBC now, especially after what the chairman said. Yeah, thanks. Any questions, I'll take it later. Any over to the rest of my colleagues, the rest of the team. Thanks.
Right, thank you, Glenn. So let me answer some few questions we got on Oracle, Microsoft, and also Palante. So first question is, why Oracle and Microsoft surged last week, the share price? For Oracle, the share price surge was because of the deal they had with the Bloom Energy for the fuel cell energy. Now the energy would come from within the data center itself instead of the power grid outside. So why is this positive for Oracle? Is because of how large the deal they have with the Bloom Energy, which is about 2.3 gigawatts. If you compare with the current data center build that they are having in the Albion, Texas. Total up will be 1.2 gigawatts. So the amount of deal that they held with the Bloom Energy is double the amount. Means that now they has already secured energy for the future data centers that they are going to build. Right. So the market is also seeing this as a better alternative compared to the traditional energy. This would allow Oracle to quicker deploy this energy once the data center is built. So, and also reduce the execution risk. For example, when you see read a lot of news, right? There's energy shortages in the data centers globally. So when you have this Bloom Energy, you would avoid that problem. And then if you look at it, this Bloom Energy also already has some deals with the other data centers providers like Google, AWS, but the size of the deal is smaller compared to what they have with Oracle right now. Because, for example, Bloom Energy current capacity energy that they have right now globally is only about 1.4 gigawatt, but the deal is about 2.3. Hence, it's like you could say that this is the largest deal that Bloom Energy already has. So it's like Oracle is ahead of their pioneers Oracle is ahead of their peers when you compare in terms of the Bloom Energy that they have. Yeah, because of the size of the deal. So hence positive for the Oracle. For Microsoft, I think the stock is recently oversold. So then the price reversal was because of the few small good news. I can't find anything material for Microsoft news. Market is bearish on Microsoft because of the slower cloud sales currently after they already spent higher capital expenditure. So when there is news on, for example, Fairweather data center in Wisconsin is now up and running ahead of the schedule, which we think the size of a gigawatt is not that big compared to the overall Microsoft size of gigawatt, but it is nevertheless, it's positive news for Microsoft, hence why the share price is going up. Because the share price is oversold recently, so people are just looking at some good news. So, and then next question is between Oracle and Palo Alto, which one would be your top choice in their respective target price? So we believe the market is punishing both of these companies right now. For Oracle, but we are more positive on Oracle because we are seeing it as a catalyst player. The catalyst is the OpenAI public listing. So Oracle price plunged back last year because of the investors are less confident with the OpenAI, whether they are able to pay Oracle after they announced their huge backlog that they have with Oracle. So we think the market will be more positive on Oracle once OpenAI goes public, and hence we could see more disclosure on the financial information, so we can better analyze the financial strength, or by 2027 when they are able to pay their commitment to Oracle. The first payment that they are able to make to Oracle would signifies that they have good financial strength to pay off this commitment that they have. Hence, would be positive for Oracle in the near future. Next company for Palante is still positive as well. It's a continuous hypergrowth company, so it's very straightforward. But the market is punishing Palante because together with the other peers in the software from the AI disruption concern, we think less, compared to Oracle, because there's always risk of market risk coming from the valuation. Although if you look at it right now, it's cheaper compared to when historically 1 to 2 years ago. It's very straightforward. As mentioned earlier, as long as the growth is still high, high growth means it warrants high valuation. I don't think there's any other large cap software, even any tech companies that is now growing at 70% year over year for their revenue. So it's quite high. So from the recent result, we see even the result is still growing quarter over quarter. So we don't think that it's decelerating anytime soon. We think they could scale further and higher, coming especially from the commercial space, not only from the government only. Yeah, so we are positive on Palante as well. Yeah, we have about $275 target for Oracle, and for Palante, sorry. For Palante, we have a target price of $190. So that would give you about less than 30 to 40% upside. Yeah. So that is all from me. I will pass over to my colleagues to answer the next question.
Hi, two questions that I see. So the first one is Serena. Last week, weekend, it announced this may estimate 8,000 staff. I think you're referring to layoff. How would it impact share price going forward? Honestly, I think the market will take it as a positive news because I think the cut was not really because of the big business moving forward, but instead it's kind of like a restructuring to have a more cost efficiency in order to fund a very expensive 135 billion AI investment, because the market, you keep saying that Meta is not a hyperscaler but spending like one. And then I think for US tech company it's very normal that sometimes they roll redundancy after restructuring. And I think with all of these internal driven AI driven efficiency talks, it makes sense for the company to have a leaner workforce. It will definitely helps with the OpEx and also margin. Yeah. And the second question is not company related, but I think I can try to answer it. Is what's your view that AI demand is inflated if looking at the consumption of token? At the moment, we currently do see the token is keep increasing, but I think that honestly I think that it will reduce it gradually, and I think it's inevitable because the more that they train all the AI agents, the more that they become smarter, they should require fewer prompt and tokens in order to get a very efficient result, considering all the AI spending. And I think the metrics moving forward, until then, it will be shifted to how cost efficient and how cost effective it is. And based on and it's very result based, as in how you put in the prompt, how does a result shows you a very like useful result, so that they once it become more cheaper and it will be able to scale, so there will be more enterprise adoption. Yeah. And I hope that answered the questions. I'll pass the time to my colleagues to answer some of the questions. Thanks.
Hi everyone. Sorry. So for the previous question, you were asking between Oracle and Palo Alto, not Palante. Sorry, I get it wrong. So for Palo Alto, we don't cover, but we do have some view on it. So for Palo Alto, the platformization strategy, the largest cybersecurity you have out there, and we do think that there's more room for Palo Alto to grow, and because they compile all these cybersecurity products all together, you get observability, you get firewall, you get the other cloud security and all that. So their strategy is that they are bundling all cybersecurities all together and selling them at a cheaper price, and also easier for the vendors to find them in one place instead of going separately. So the theme is that as more and more artificial intelligence is being used out there, it would benefit cybersecurity companies, including Palo Alto, because now they are moving toward more AI agents cybersecurity. There's a narrative that they are moving forward with. They are handling on the identity theft possibilities, that they are banking on that right now. So it's still immaterial, but then again, that's a good prospect that we could look at. So we are positive on Palo Alto. They are also have a huge cash where they keep using it on M&A opportunities. So they are kind of like mature companies within the cybersecurity, but they keep growing with the M&A opportunities that they could have. Yeah. So that is all from me for Palo Alto. It's quite short.
Darren, you want to go ahead?
The question from what's the strategy rationale behind selling Asia Square Tower 2 and buying Paragon, and how does it fit into CapitaLand's CICT's overall portfolio strategy? Yeah, so for this particular transaction, they are selling the Asia Square Tower at about an exit cap of about 3%, and they're acquiring the Paragon at about 3.9%. So if you look at it, it's actually accretive. So overall, the deal is about 2% accretive as well. So how does it fit into the overall strategy? Is basically our thing is a more yield accretive, and as well as acquiring Paragon, which is like a flagship kind of Singapore retail properties, like in the heart of Orchard Road as well. Yeah, and even though they are like selling the Asia Square Tower is mainly a commercial and buying to retail, we don't really see it as a strategic pivot into retail. It's just more of a yield accretive strategy. Yeah, and can drive DPU growth as well. Yeah, so I think that is mainly the rationale behind it. As they also see Asia Square Tower probably has already matured and there's not much room for rental growth there anymore. Yes, compared to Paragon, which has seen about a 3% rental reversion um, uh, throughout the past few years. Yeah, I hope that answers that question. Yeah, I think that's all. Yeah, and there's another question. Yeah, the deal is about 2% accretive. Yeah, because after they're selling at about 3% MPI yield or exit yield and acquiring it at a 3.9%. Yeah, I think that's all for me. Yeah, hand over to my colleagues. Thanks.
Hashim, can you?
Yep. I think there's a few questions on SIA. Is SIA considered low now since oil price plunge? I think this depends on their current status and their future growth and risk profile. To answer this question, I think we can also take on the other two questions. So what's the financial impact of Air India's losses on SIA's bottom line? So the Air India loss is 2.4 billion USD, and SIA owns 25% of Air India. So that's about 600 million USD. And if we look at SIA's bottom line, for us, our consensus is that net profits will be about 900 plus million. And this is quite a huge loss, which accounts for about over 70%. We already made concession for Air India's losses. So the concession we made was about 800 million SGD. The current losses are about 600 million. So they're about net, it's around that amount. But it's a substantial impact to SIA's bottom line. How do you see the Indian aviation market evolving? So I think we all know the Indian aviation market, one of the fastest growing, but the airline with the largest market share is Indigo. It has over 50% market share. SIA's positioning in particular is dependent on Air India's positioning, and the key difference between Air India and Indigo is that Air India is more focused on long-haul international flights, and this is a key issue for Air India. First of all, crude prices have increased. As a result, jet fuel prices have also increased. So that's a huge operational expense for Air India. Secondly, we know that Pakistan closed their airspace to India, and this has been going on for over 1 year. And this airspace is very crucial because it's the key airspace for flights originating from India to overseas. So if this airspace is closed, you're going to be looking at about 15 to 30% increase in your flight time, which also means you're going to be spending more on fuel, which affects their profitability. So the way we see it, Air India will continue to be a laggard on SIA's bottom line. Operationally, we find SIA to be strong. Their core operations are still very strong, but Air India will continue to be a drag, and it would be a significant drag because they contribute to over 80% of earnings in terms of losses, and it might take some time for these losses to reduce before we are going to be seeing a profitability for SIA. So with that in mind, we think SIA is not necessarily considered low. at the moment. The good thing about SIA is that they have hedges on both crude oil as well as jet fuel. So they are relatively insulated from your jet fuel price increase. But the main factor that affects their profitability is not their jet fuel price, but rather the drag from Air India, which we expect to continue. So on that aspect, we think it's not necessarily considered low at the moment. And I think the third question is also the same thing. Do you reckon it's a burden to SIA for financial support? So SIA has a strong cash position. They would be able to support Air India, but it depends on how much they're able to provide funding for. Air India's CEO resigned, which is not a good sign, obviously, and I think it's too early to comment also. But overall, this might affect SIA's ability to pay dividends in the end. Yeah, so if we were to look at whether they're going to prioritize dividends or paying financial support, I think overall they want to keep investors happy. They would focus more on paying their investors dividends, and we have to see how much of the loan SIA wants to take between them and Tata, which is another shareholder for Air India. I think that's all we have for SIA. I'll pass on to the others.
Yeah. There's a question. What is the target price for Nvidia and Apple? Means that can someone at least type it down, Alina? According to Poem Stock Analysis, Franken, OCBC, and Penn United have the target price below their present. Does it mean it's time to take profit in the stocks? Yeah, we will probably have to evaluate again on our target prices. Like for Franken, when we initiated, it was $1.30. So this was in July. So the share price they doubled. So we already raised our target price multiple times. So I will leave it to Yigban and he's not around, but I'll leave it to Yigban and Glenn to talk about their target price on OCBC. There was a recent negative report on Keppel by Corporate Monitor. Any comments on this? Yeah. So the Keppel, I think they wrote. I just opened it up. I mean, I didn't really. They spent 19 pages to talk about the Keppel privatization. I think 19 words is okay. I just tell you that it's not a good deal, obviously, because there's a price war happening in Singapore telco sector. So obviously operationally it's going to be very weak because you're facing this big price war right now between all the telcos. Yeah, and so I really have not much comments on this because so the thing is the deal was bad. So do you want to sell it or wait until they find a better buyer and better performance? So for me, I'm just looking at the 1 billion cash and that's it for me. Yeah. I didn't really read through every single detail just to tell me the deal was bad, which I think don't need to read 19 pages. I can 19 words. Okay. Yeah. How high Paul is Singtel share price weak recently because of the discounted shares? I don't think I think the discounted shares definitely has probably has some impact on the sentiment. I think the discounted shares, the average person holding it will be 50 years and above. So I don't think anyone when they have the shares, they're probably going to sell it. So but we also think one other reason is that the emerging market, I mean, that's our own view, like we mentioned. Most of Singtel's growth markets is Thailand, India, Philippines, Indonesia. So all these are going to face macro headwinds in the very near term that we highlighted, and then we think that is probably one of the other considerations. That the growth momentum for these emerging markets will probably drop a little bit because of the whole impact from inflation, the high oil price, and so forth. Because in emerging markets, mobile consumption is a semi-discretionary product. Yeah, hi Paul, how do you view IX Biopharma's recent announcement? CEO Eddie Lee sold 10 million shares at 26 cents and placement to Anson at 42 cents. Yeah, so I did a check. I think I used Gemini deep research to do this check out. So anyway, since IPO, Eddie hasn't sold the CEO and founder, I guess, hasn't really sold any shares since the listing 10 years ago, about 2015. And he's been also injecting a lot of capital into this stock. Based on their analysis, maybe 6-7 million through all the rights issues, placements, warrant conversion, all that. So after 10 years, maybe he sell a bit. I think it's fine. I mean, yeah. He held this stock for 10 years, yeah, and he never sold one share before, yeah. And then there's liquidity, so I don't blame him. He also need to find some liquidity. He's been just injecting money into this company. And the other thing is, the placement to Anson is a bit of peculiar because there was a rights issue in 2024 and Anson didn't participate. And then they actually kind of defaulted on their pro rata. That means they owed the company this so-called 400 over 1,000. So they had to take this up, and that's equivalent to 440,000. So it's a bit of some technical thing because Anson didn't participate, and then now they pay the price. They get less shares, and then they have to pay it at 42 cents. Yeah, so those were the technicalities. So my general view for IX is take a longer term view, not that 1 or 2 day. I know longer term, maybe 1 year or 2 year view, that this company could, following the US government almost sponsoring the development and also buying their product, is a testament to their product, and that the ability to get the phase 3 FDA approval is high. It's not 100%, but it's high because you got virtually like a sponsorship from the US Army. And then they are the sole procurement. So in the contract, this is called the sole procurement contract. So there's only one supplier of this product to the US Army, and you can just assume that they also want this product to go through, I guess. And you're talking about a product that can go global. Paul, I noticed that even after MAS adjustment, the Sing dollar is still weak against the ringgit. In fact, observation 2 weeks before the Sing dollar did strengthen, and then the ringgit. I don't really follow the ringgit. The MAS policy is against the basket, but I think ringgit probably strengthened because all the energy exporting currency strengthened. So that is one possibility. But sorry, I don't really go through like really deep analysis on ringgit. Dividend and REIT investors prefer a strong Sing dollar. I don't really think so, because especially if you have REITs with exposure to Australian assets, or China assets. So if you are a Maple Tree investor, I don't think you want too strong a Sing dollar, because they actually kind of hurt them, especially if, those that had Australian assets. So it may not be necessary so, because if you have foreign holdings, REITs with foreign exposure, I think they get hurt by a strong Sing dollar. Has the current share price of Franken reflected optimism? To a certain extent, yeah, definitely. I think because the share price doubled, I think more than doubled in 1 year. But we still think there's upside because we don't see Franken announcing strong results yet. So I think this stock can carry at least until the earlier next year. That's when the real test is when Franken announce strong results. I think you see how the price action of this stock. But I think there's still momentum. As mentioned, the next phase is to watch all these IPOs. So once these IPOs come out, the US IPOs, this will give another round of funding for all these hyperscaler spending. Let me answer this last one before I hand it to Zain. Sorry for so long. How do you view the growth of Alltech? What is the target price? So my target price is 272. So the next share price driver will be if they sign the definitive agreement with the Sarawak on the SAF. Hopefully, they can also announce other contracts. And there's also one thing that Alltech always likes to do, which the last time they did was a bonus issue. I do not know they're going to announce a bonus issue or not, but the last time they did, the share price was, correct me if I'm wrong, I can't remember the exact number, but maybe around 150. So I wouldn't be surprised if they announce another bonus issue. But and then the growth, once the definitive agreement is signed, then that could also help the share price. Yeah. Okay, let me answer this last one. Hi, Paul and team. Any view on PC Partner, what they do? Yeah, okay, so I did meet PC Partner. They were interesting, but we helped back in initiating them. I think we met them quite earlier. Just that they are very dependent on this whole GeForce. So they technically sell their branded graphics card. That means if you want to enhance, you want to play games, you want to get a nicer visuals, you take this card and then you put it into your PC. Of course, so and every 2 years, when Nvidia upgrade their GeForce card, the RTX, correct me if I'm wrong, I think it's RTX. Then when there's a big product refresh, the share price, the earnings will run, and then after 2 years, the earnings will come down. So we just didn't like it because we thought it was a bit too cyclical. And the other view is that we were just a bit worried that Nvidia will focus more on their GPUs. I mean, naturally, most of the earnings now come from GPUs. So that's why we took a step back on PC Partner. Although it's a good company, we just thought that this is like a 2 year run, then come down, 2 year run, then come down. So that's why we kind of didn't initiate on it. Yeah, but it's a good company because again, they are a branded product, but they're very reliant on Nvidia's GeForce graphics card. So we just thought that if it's just relying on that, then it technically almost like a reseller. Yeah. Okay, I hand it over to Zain. Yeah, sorry, we can't take on all the questions.
Yeah, thanks, Paul. I'll move on to the TA questions. Yeah, so first question is on WeHer. Yeah, so looking at WeHer chart, I think currently it looks to be a bit of a consolidation after a bit of a run out recently. So some resistance at the 78.5 cents level, which was this previous resistance from September to October last year. And price, you think probably will do a bit of a sideways consolidation for now. Things support is likely to be around at the 74 cents level, I think, over here. 74 cents to 75 cents level, and then current resistance about 79 cents. So most likely some sideways consolidation first, I think. Then possibly if there's a breakout of this 80 cents level, then I think could head towards maybe towards the 84 cents to 85 cents level next, which was this previous range back in February this year. Next question on Pan United. Yeah, for Pan United, I think price some slight pullback recently. I think overall it's still a very strong uptrend. Yeah, so I think some pullback below in terms of the weekly 5MA is currently below 164, and then on the daily chart also currently below the 10MA, which is like 167. So maybe some slight pullback that could bring the price some pullback towards maybe 155 to 158, this area. Then maybe some sideways consolidation. Next one, Bank of China. So I think for this 3988, still very strong momentum since the breakout of this 460 to 470 area. And recently, I think last week, I think price overcame these resistance at around $5, and then they retest over here at 10MA, which was also this previous resistance and found support. So I think overall still very strong momentum. I think we still like to see new highs again. Yeah, and potentially to maybe target the upper Bollinger Band levels, maybe at around 530. Yeah, so still very strong bullish momentum right now. Next one is on Manulife US REIT. Yeah, for Manulife, I think price did a retest of around this support level around 0.054. I think overall still a weak downtrend and facing resistance, I think, from the 20 SMA level, this yellow line. So currently, I think some resistance at 0.057 right now. Yeah, and most likely I think we'll do a bit of a sideways. 0.057 is a bit of resistance. Afterwards, it's 0.060. So most likely some sideways consolidation at this area. Okay, next one, for ComfortDelGro, I think some rebound recently. So I think price after a sideways consolidation broke out of this 147 level, also 149 today. So I think could hit the next level around this 151 to 152, this gap over here. Yeah. And then afterwards it's like 144, 155 level. So I think the stock price could inch up slowly for now after breaking above these 147, 149 levels. Yeah. Maybe to hit about 152, and then next one is 155. Next one for Rex. Yeah, for Rex, in terms of the share price, last Friday had a surge, and then we tested this level here, 0.109, then some pullback today. I think price, in terms of now, I think do some pullback, and then finding support at 0.091, this previous horizontal level over here. So I think then maybe price will do a bit of a sideways movement. Yeah. Next one, some US counters, like MasterCard, Visa, Microsoft, NP. So first one for MasterCard, I think in terms of the price action, some rebound recently after price broke out this range consolidation between 490 to 505 last week, and then retested these resistance levels at 525. So some slight pullback. I think price most likely will do some slight pullback over here, but will find support around 513 over here. And then afterwards, if you can overcome this 527 resistance again, next key level will be around 543. So it's for MasterCard. Next one for Visa, I think kind of similar as well. Last week broke out above this consolidation at 309 to 312. And I think price most likely inch up a bit further to test this key resistance area, be around 320 to 325. Then maybe some sideways movement afterwards. Yeah. And some support for now will be around 312, around this 312 area. Yeah, then for Microsoft, last week it had a quite strong rally, and then actually we tested the 100 SME level, this blue line over here. So, and then just pull back slightly on Friday. So I think for now, could do a bit of a slight pullback after a sharp rally last week, and also retesting this 423 swing high level as well. So I think for now, some slight pullback, we could see support being formed around 407 to this 412 level over here, and probably a retest of the 5 SMA level as well. And then afterwards, I think we'll do some sideways consolidation afterwards. Next one for NVM, Nova Minerals. Yeah, for this actually quite a low volume counter. But overall, looking in terms of the trend, is a very large sideways consolidation between these $6 to about 11.30. And recently, I think not much movement. So some resistance probably at this 720 level over here. For now, and then support is around 640 over here. So most likely, I think we'll do a bit of a sideways consolidation over here. Then if we can overcome 720 afterwards, then the next key is around 820 to 850 level. So overall, I think still quite sideways for this. Next one for SGX and OCBC. SGX, I think still strong momentum. Price in terms of the longer term chart, I think start of April managed to break above this quite a key trendline resistance, and then price has been just steadily inching up along this trend line, and so along the 5 SMA level as well. So still very strong momentum. I think could still see higher highs to come, and yeah, some near term resistance maybe around $22 about it, but still very strong momentum, I think. And for OCBC, I think most likely some sideways consolidation for now. Some resistance are around close to $23, but support is holding at an SMA level, which is around 22.60 right now. So I think, and also forming some higher lows along the way. So looks like some sideways consolidation, and then afterwards, I think once price can break $23, then we can see the trend continue towards maybe about 23.70. If you take the height of this range rate, which is like 70 cents from 22.30 to about $23. Okay, I'll take one more since it's about 1 o'clock. Next one for Ultra Green. Yeah, for Ultra Green AI, I think the share price has been quite weak. And generally finding resistance along 10 SMA level, this red line, and recently also broke down some key supports around this 143 and then 149 level as well on last Thursday. So I think we'll most likely see continued weakness to test this 131. This 131 previous, I think the lows, which was in December last year, then maybe some slight rebound. Yeah. I think that's all from me. So unable to take all the questions in view of time. Feel free to post in our Poem Street community, then I'll answer it over there. Yeah, I'll hand over the time back to Paul if anything to add on. Thanks.
Sorry, let me just share the Keppel DC REIT slide again, since there was a question on it.
Okay. There's one question on your views on Stornowig's performance after CEO's presentation, which I missed. I'm not sure if they did do a presentation with us, but let me just answer that we are still positive. I think not to put words in Darren's mouth, but we are still positive on Stornowig. Their yields were 8%. And more importantly, it's one of those few REITs that the rent is pegged to CPI. So I'm not sure how many REITs are actually in Singapore that's pegged to CPI. But I think that's why it makes it a bit more unique in this environment. Okay, with that, like to the ultra green. Sorry, we don't really cover ultra green. So we can't really give you a good answer why the share price is down. With that, I'd like to thank everyone for your time and spending your time with us and all your questions. Sorry, we still got, I think, just a handful more we couldn't answer because we tried to stop at 1. And thanks again, and really wish everyone a wonderful week ahead. And thank you for your participation. Thanks again, everyone, and take care. Bye bye.